Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Tim Regan is on the show today. He's managing director at Kingwest and Company, and we'll be taking your questions on North American Equities. Here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Tim joins us in studio today. It's great to have you.
Oh, great to see you.
So lots to talk about, as always. I think we'll start with kind of the big picture. What everyone's looking at right now is the ongoing roller coaster when it comes to the markets, the price of oil. What's your kind of strategy throughout all of this that we've been dealing with?
The strategy is really to look through it. And when I say look through it, you can't get caught up in the day-to-day roller coaster. The one thing that happens is when we look at the price of oil, the real price is the price at the pumps, whether it's here in Canada or the price at the pump for summer driving in the US. And I think that will dictate a lot of the geopolitical strategy. Mr. Trump cannot afford to have a bad economy going into a midterm election. And I think a lot of what you see his reactions to in the Straits are more to what can happen to the US on an economic basis.
Right. He hears what people are saying, consumers.
Correct, yes.
Lots to look forward to. You mentioned midterms, that's way later this year. But of course, we've got these renegotiations of CUSMA coming up in the summer. And you say capital investment is soft and will likely remain that way until there's some kind of trade deal worked out between Canada and the US.
Well, I mean, the market likes certainty, but there's never certainty. And it's much less certain now. But when we look at the renegotiations, they have come out and said that some things are pillars. So I don't think we're going to see everything just scrapped, but it would be nice to see a lot more clarity so that businesses can actually plan for the next few years. And if we get that clarity, that will be good for our economy. Are
you optimistic that we'll get that clarity at some point throughout the summer, or?
I'll say we'll get more clarity, but not perfect clarity. But it's something that has to be addressed not just by Canadians, but by the American government as well, because their people want to know what they're doing. You look at places like Kentucky. Kentucky I didn't know that we drank that much bourbon in Ontario, but they lost a distillery. Mm-hmm. So Americans are hurting a bit with the tariffs.
We're also watching interest rates, because I was wondering today when we see Canada's inflation rate take up for the month of March, I was thinking, will this affect how the Bank of Canada reacts in the future? You say the path of interest rates depends on two things. What are those?
Well, I guess right now the path of interest rates depends really on what's going to happen with inflation. Now, if inflation is just caused by higher gas prices, and we saw today that gas prices were up 20% in a month, is this temporary? Does it really mandate a raise of rates? I don't think so. On the other hand, does this affect our economy? And if it spills through the economy, it continues, and we go into a recession, rates will have to be adjusted lower. But right now, the rates, we see a lot of the last of the 5-year mortgages at the very low interest rates are coming off this year. So mortgage inflation won't be as big. But I think that if you really want to see housing and real estate get back on its feet, you do need rates to stay here or lower.
Got it. Okay, we're going to take a quick break right now, but we will be back with Tim Regan of Kingwest and Company taking your questions on North American Equities right after this. Here's how you can reach us. Welcome back to Market Call. We've got Tim Regan on the show today answering your questions on North American Equities. We're going to start with an email question. This is coming in from Dan, and it reads, can Tim comment on Oracle? Short and sweet. Tim,
there we go. Thoughts? Well, when one looks at Oracle, and the company it's a $500 billion tech giant that's been around with us forever. And if you look at the chart, Oracle to us today is still fairly expensive. They've made a massive bet on AI. Just the other week, they started laying people off. We think that, Oracle's a little fraught with risk right now. If things pan out, it could go up, but if they don't, there's still probably a lot more downside.
What needs to happen
Oracle.
for Oracle to, like, what do you mean by pan out?
Well, they've made massive bets in AI, and it just has to come through as cash flow in the future.
That's the story, I think, for a lot of
That's every company. It's all about the cash flow in the future. So are these bets, if you want to call them that, as Google does, or investments, are they going to pay off? And so with it trading fairly highly right now and at a relatively expensive valuation, even though it's dropped a lot, there's a lot of optimism embedded in it. And that's not the kind of companies you want to buy, that there's way more optimism than pessimism.
Got it. Okay, we're going to move on. We've got Fred calling in from Stratford, Ontario with a question. Hi, Fred. What's your question?
Hi. Thanks for taking my call.
Hi, Fred.
Mr. Regan, my question is regarding the takeover of secure waste infrastructure by GFL Environmental. I know you own both of them because Mr. Fogler, your founder, has recommended secure waste a couple of times before. So this offer, this transaction involves 20% cash and 80% stock of GFL. We got a little bump in the stock of SES, not very much, but we got a much bigger drop in the stock of GFL. And I don't know, as an owner of SES, I should feel happy about this transaction or not so happy. I just can't figure it out. I would appreciate any input you can give me. Also, I think SES is a more growthy company than GFL, and I don't know long term if this transaction is beneficial to us or not. Thank you very much for taking my call. Bye-bye.
Okay, thanks, Fred.
Okay. That was a lot, Fred, but I hear where you are. We own both. And right now, what you saw was with the takeover, GFL stocks, if you look at GFL, dropped about $10 initially or so, as you can see in this chart right here. What happened was a number of investors thought GFL was off strategy from solid to liquid waste. It's still on their strategy. It's not won't be a large component. They are picking it up at a fairly decent price. And I think it was probably either late last week or early this morning, that one of the investors in Secure has said that they won't tender in. They would like a little more money. So when you say, should I stay with it? I think with Secure today, there's probably a lot more upside because you might see a sweeter offer. I can't say that, but right now, it doesn't hurt to hold on.
Okay. All right. We're going to move on. John is calling in from Milford, Ontario with a question for Tim. Hi, John. What's your question?
Good day, Lindsay and Tim. I have a general question on the banks. I've owned them for a long time, and I'm up huge, and I'm starting to get a little nervous. Are they not starting to get a little frothy? I can see a big correction in the banks. What's your thoughts? Thank you very much.
Thanks,
Bye.
John.
Canadian banks, I always like to say, are the best known oligopoly known to mankind.
Right.
Nobody else makes 20, 30, 40% return on equity. And so when one looks at the banks, it's interesting. We always think they never get too overvalued. The valuation ranges change, but you're talking about perpetual cash machines trading in, anywhere from 11 to 14 times earnings with big dividends. The other thing as well is with the Canadian banks, if you're thinking of selling, where are you going to put the money into? And did you make a lot of capital gains? Because you're going to pay a lot of taxes. And the other thing as well is, we don't really know what's going to happen in the next 3 weeks with banks. They could go up another 30% before they correct 20%. And so if you're looking at the banks, we think that they're a long-term hold if you have a very low cost base.
So, and as you say, you don't know for sure, but it doesn't look as though there's a correction in the near future.
It doesn't look that way, but nobody knows at all. And it's, and with the banks, they're actually doing fairly well currently. Do we get a correction in our economy? In the real estate market, there's a bit of a correction. They seem to be going through it. So, I hold the banks for now.
Okay. All right, going back to the phone lines. Terry's calling in from Edmonton with a question. Hi, Terry.
Good day. Yeah, my question's on Allied Properties. So it seems to be selling way under net asset value. And is there a possibility that foreign investors could come in and scoop it up like they've done with a couple other REITs? Thank you very much.
Great. Thanks, Terry, for that question.
No, it's a great question, and I'll agree with you, Terry. If you look at it, last week a deal was done between Kingset Choice Properties for First Capital. And First Capital, it's a different real estate company, but went for over their NAV, which is their net asset value, the accounting value of the real estate, which was somewhat surprising. Allied today, we own it, and we have a valuation on it. It ranges anywhere from about 22 to their reported, I think it's 27 NAV. So if you look at it, that's a huge gap. It might not be worth its NAV, but it's worth a lot more than it's trading at today. And Allied's had a number of missteps in the last little bit. Their newer management team hasn't covered themselves in glory, but the assets are very, very good. And a takeover is well in the realm of possibility.
Interesting. Okay, we're going to take a quick break right now, but we'll be back with Tim Regan of Kingwest and Company, taking more of your questions on North American Equities right after this. Stay with us.
Looked at that in 10 years.
Welcome back to Market Call. We're joined by Tim answering your questions. We're going to go right to the phone lines. Chris is calling in from Delta, BC with a question. Hi, Chris. What's your question?
Oh, good morning, Lindsay and Tim. Thank you, as always, for taking my call. Tim, I'd like to ask you about Microsoft and whether or not you still see it, or if you see it in the first place, as an attractive long-term hold. And after this bit of a mini rally that we've experienced, if you would still be, if you do like the name, picking it up at these levels for a long-term investment. I'm a 30-year-old investor in a TFSA account, and I will hang up and listen. Thank you so much. Take care.
Okay, thanks, Chris, for that. Yeah, Microsoft, a good time to buy on the dip for this company, or not so much?
Well, thank you for asking me that, and it's a good thing you didn't ask me 2 weeks ago, because we didn't own Microsoft. We just bought it very recently. Microsoft was down about 30% or more. We all know the basics of Microsoft, but one of the big things as well is with AI, OpenAI, Microsoft's a closed environment. So Microsoft users or companies can actually tap into that closed environment, use AI to actually help their business. And I think that will be a big boost for Microsoft going forward. So a lot of the, I guess, downfall was because of AI. Microsoft should do very well in the new AI.
Okay, so you just bought some, so you think now's a good
Yeah,
time?
I kind of caught me off guard, but yes, so there we go.
Okay, all right, moving on. Caleb's calling in from Winnipeg with a question. Hi, Caleb.
Hi, thanks for taking my call. My question is about CP Rail. Would now be a good time to start a position? Thank you.
Thank you.
Sure, since we've owned it for about 3 years now, as you can see all the bumps and ups and downs, we think it's a good long-term business. We've seen a little pullback, of course, especially with tariffs. And as you know, CP's really goes right through from Mexico, US, Canada. It's a great railway. So yes, we hold it now. We think there's a lot of upside. And if you want to start a position, we're still actively buying.
We're going to move on. Jack now calling in from Toronto with a question. Hi, Jack.
Hi, Lindsay. Hi, Tim. I have a question regarding U.S. banks, specifically Citigroup. I have a small position. I was wondering what Tim's thoughts on the whole U.S. banking sector and whether or not I should add some more into Citigroup. Thanks very much.
Thanks, Jack. Tim, what do you think? Do you have a preference at a U.S. banks, first of all? Would it be Citigroup?
We have 2 U.S. banks in our portfolio, Citi and JP Morgan. JP because it was the best in breed a long time ago. Citi just because it was so undervalued. Citi's come a long way. Usually throw up the chart, but you can see the Citi chart. We waited a long time for Citi, and we still think there's more left in Citi right now. And the U.S. banking sector, as you can see, there was a little downdraft. People were worried about credit problems, but the whole private credit, I guess we'll say, problem out there is not with the banks. Since 08-09, the banks really can't lend to that type of business. They're more secure than ever. So they'll have pockets where different things can happen, especially in a soft economy. But I think the U.S. banks are actually safer than they ever were. And now they're starting to earn a lot more money. Is
it the same story as what we were talking about earlier with Canadian banks, where some people are kind of anticipating a correction maybe coming at some point, or is that not the situation downside?
I think they are, absolutely. I mean, you can see it in the share price, and the share price goes up and down. A lot of the banks as well, we look at their banking mortgage business, but where they're really coming on strong is their trading, their capital markets businesses. And that's been a great booster of earnings, not just for some of the Canadian banks, but for the U.S. banks as well.
Okay, we're going to take another quick break right now, but we'll be back, of course. And when we return, we'll take a look at some of Tim's past picks. That's next. Stay with us. Welcome back to Market Call. We're going to take a look now at some of Tim's past picks. So these are from November 19th, 2025. The first one, Tim, that we'll go through is Strathcona, recommended at $42.81. Now at $36.63, still a total return of 11%. But you still holding this one?
Well, we are. And it's interesting because, as you can see, that big dip, they paid out a $10 dividend. So if you look at it, and as you can see, that $10 dividend December, really would be trading at almost $47 today. Strathcona is a smaller, it's actually fairly decent size, but smaller in the grand scheme of things, oil and gas producer. They just do a fantastic job, great management that owns a lot of the stock. And as an oil and gas play, we really like Strathcona.
So you're going to keep holding on to Strathcona?
We are keeping.
Got it. Okay, next one is Quebecer, recommended at $52.40. Now at $56.19, a return of 7%, total return of 9%. This one doing pretty well so far. You still like it?
We do. I mean, Quebecor of all the telcos is actually gaining market share with the Freedom Mobile. Quebecor, you can look at the chart. I think the chart tells you a lot about where it's been in the last year. Eventually, it'll run out of steam, but it's not quite there yet. But in the whole telecom space, we think Quebecor's the best.
You say it'll run out of steam eventually. What do you mean by that?
Well, you have to realize that the industry, it's another great oligopoly, but it's an oligopoly where prices are falling. And so, eventually Quebecor will run out of steam because you're seeing the package plans going down in price, and that'll strain everyone's margin at one point or another. And you're starting to see it in some of the other telcos.
But you said you like Quebecor better than its peers?
Yes,
why is that?
Absolutely. Just because it's growing. It's the one that's growing. They're taking clients from everyone else.
Got it.
So.
Okay, your last past pick is Blackstone. So we'll take a look at what you recommended Blackstone at $138.65. Now at $129.81. I heard you make a noise there as I brought in Blackstone. What happened here? Are you still holding this one?
We are. I mean, great long-term stock, but here it is, it's down. And as you can see, Blackstone is an alternative asset manager, private equity, private credit, infrastructure, real estate. With all the turmoil in private credit, you can see the big drop. But overall, what's happening with the alternative asset managers is the biggest ones, so the Blackstones, the KKR, the Brookfields, are actually still raising a lot of money. And so the engine is still there. And so you'll see some issues on the credit side. Most of it is more people running out the door than actual defaults, which happens from time to time. And I think if you're going to look at asset managers to buy into, alternative asset managers, you want the biggest and best. And so Blackstone, we think it's going to surpass that high that it reached in September or October. And this is another one that it's a juggernaut. It's fantastic.
And even as we were talking about at the start of the show, right, when it comes to private credit, you expect maybe a bit of a turnaround later in the year.
Yeah, I don't know what will happen with the private credit later in the year, but really the stress on the private credit is everybody wanting their money back, and it's the semi-liquid alternatives. And, you can't lend to someone for 3 years and have people wanting their money back after one. A little bit of a mismatch, and that's how these were formulated. So there'll probably be a little bit of pressure. There always is, whether it's private credit, high yield at one point or another, but it's not the it's not the apocalyptic view that many people have on it.
Got it. Okay. Well, that's a nice optimistic note. We'll end that there and take another quick commercial break. We'll be back, though, with Tim Regan of Kingwest and Company, taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. We've got Tim here answering your questions, and we're going to go straight to the phone lines. Michael is calling in from Montreal with a question. Hi, Michael.
Hi. Would it be possible to have the guest's opinion on Uber and for like a long-term hold? And can you also comment on Uber's recent acquisition of Blacklane from Germany, and as well as their recent, like a few days ago, they announced an additional 4.5% stake in Delivery Hero, which is based out of Europe and Germany, which is a competitor of Uber Eats. Thank you. Bye-bye.
Okay, thank you. A very informed caller on Uber. What are your thoughts on the company, long-term hold, and yeah?
Sure. So I'm going to say we bought it just under this price and went all the way up. It's down to this price right now. We actually like Uber. It's another company that is a great long-term hold. They're creating a lot of value. They're trading relatively cheaply. They earn a lot of cash, which is great. And part of what you're seeing, you commented on, some of their acquisitions, the competitor to Uber Eats. They do a good job in buying these things and rolling them up. They also have autonomous cars coming out, and that's going to be a real game changer. We'll see, how that's integrated as well. But I think that all in all, Uber is a good long-term hold. As long as they're on track, and really they dominate in all the markets they're in. And so you'll see more and more of these roll-ups, and the Uber team is pretty good at making smart acquisitions.
Yeah. Okay, we're going to move on. We've got Lawrence calling in from London, Ontario with a question for Tim. Hi, Lawrence.
Good afternoon. I'm trying to decide which engineering stock to buy, WSP, TSTN, or ATRL, please.
Okay. Thanks for that.
Yeah, so engineering stocks, we do not own any. They always tend to be too expensive. In this cycle, everybody's bid a lot of them up on future infrastructure needs. So right now, engineering stocks are something that we don't own, pure plays anyway. But I will be talking about one of my picks that has a division in engineering services a little later on in the show. Is that
more
that's
to come?
Okay?
Yeah,
More to come.
We'll tease your top picks. That's coming up later, and so we'll keep talking about that. Hopefully that answers some of Lawrence's questions when it comes to engineering. We're going to move on now. Jim is calling in from Elliott Lake, Ontario with a question. Hi, Jim.
Hi, good afternoon. Just your thoughts on CNQ. Obviously, it's had a nice run, but over the last month, it's had a bit of a dip here, a little over about 11.5% is what I'm seeing here. But your thoughts on maybe an entry point today?
Okay, thank you.
Well, I mean, CNQ is a company we own. We did trim a bit of it a few weeks ago, not because we're timing geniuses, but when oil gets to 110 a barrel, you know that oil might be coming down. So, I mean, if you really look at the chart, it's a great oil and gas company, but it's all what the price of oil will do. So, you know, is it a good entry point now? We still hold some. But if oil goes down, no. If it goes up, it's great. And that's kind of unfortunate in the short term when you're looking to get in. You really want to get into some of these companies once they've been beaten up and the price of the commodity is low. So I know I'm not answering your question directly, but
that's what I was going to say. Like for Jim, then maybe not the best time to get in, or it depends on your own personal portfolio.
If he can tell me what Mr. Trump's going to do in the next month or so, then, you know.
I don't know if anyone can.
No.
Okay, we'll go back to the phone lines. Robert's calling in from Burlington, Ontario with a question. Hi, Robert.
Good afternoon. Currently, I'm holding Diamond Estate Wines and I'm holding Peller Estate Wines. I think they both have some nice advantages, both underpriced. Peller's paying a nice dividend. What are your thoughts on the Canadian wines right now? Thank you.
Okay, thanks for that.
Another
industry.
Yeah, it's an industry I like, but to drink, not to own.
Yeah.
No. I mean, the companies the wine companies are fairly well run, but it's a tough area to do business in. The margins are thin. We've seen there's a lot of taxes involved. Look at the interprovincial borders. You tell me when, you know, interprovincial trade is actually going to be a thing, because it sure hasn't.
It's supposed to be last summer.
Yeah. Now you've seen a couple deals, but you know, it's easier to get French wine than wine from BC. And so when you look at that, you know, they pay a decent dividend. They never trade too expensively, but the growth is really not there. And part of the growth is also fighting a headwind against people just not drinking as much anymore. You know, if you really want to look at it, look at a lot of the breweries out there. Look at Molson Coors and their share price. Nobody wants to drink beer anymore, maybe except for me. But
people drink less than they used to.
They do,
right?
and the big thing now is non-alcoholic beverages, and so it's hard to replace wine with a non-alcoholic wine and have it taste good, whereas they're doing that with beer and still charging the same price with no taxes. So.
Yeah. So you personally staying away from some of these wineries?
Well, yeah. I mean, they're very tough businesses, very competitive businesses, and as well run as some of these companies are, it's a tough environment.
For sure. Okay, we're going to take another quick break. We will be back, though, with Tim Regan of Kingwest Company, taking more of your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. We've got Tim Regan on the show today answering more of your questions. We're going to go to the inbox because we've got an email question coming in from Brian, and it reads, may I have your assessment on Power Corp? Would you wait for a pullback to add to this stock? Thanks for that question. Tim, what are your thoughts on Power Corporation? Is that something you're interested in, or?
We don't own it, but it's one of the great big Canadian insurers. We do own Sun Life. We've owned Manulife and Power in the past. Right now, it's getting a little pricey. You know, for a company like this, 3 years, 100%. We should have owned it 3 years ago. It has a lot of great assets. The insurance business is really the engine. But you know, with the Desmarais family, Sagard, they're into Wealthsimple. They have a lot of venture capital, and they have a great asset management business. That's a good engine as well. So right now, you know, I mean, we don't own it. It's run up a bit. When do you buy it? I don't know. Does it pull back or not? But it's a little, I wouldn't say it's on the expensive side, but it's fairly well priced.
Pretty high at the moment. So maybe for Brian, I take your point. You don't know if there's going to be a pullback, but maybe wait in case
Right.
there is.
And one thing too, Brian, there's great companies, but it's all about the price you pay. And we see that in the market all the time. It's paying the right price for the company. And so patience is probably your best ally in this marketplace today.
Okay. All right. We're going to go back to the phone lines, actually. We've got a caller. Harry is calling in from St. John with a question for us. Hi, Harry.
Hello.
What's your question?
Yes, regarding Telus stock, it's at a 10-year low point. I failed to execute a stop loss, and so I'm down 20% or more. I'm wondering, is your guest seeing it as a buy, a sell, or a hold? And the dividend, which is currently over 9%, does he think that's sustainable? Because if it's not and they cut the dividend, it's going to drop to a $10 stock. What would he do if he was stuck with Telus? Thank you.
Okay, stuck with Telus. Thanks for that question.
Well, just to tell you, Harry, we are. No, we have a small position in Telus. And right now we're holding on to it. We're doing a little more work on it. But remember, Telus bought a lot of things that in our mind, looked to make sense, but they didn't integrate them properly. Telus has a new CEO coming in July 1st, Victor Dodig, who ran the Commerce Bank. Victor is a very astute guy. I think once he gets in, you'll see a lot of changes in Telus. Will they cut the dividend or not? They might cut the dividend, but usually when people say they're going to cut the dividend, you think it may go down to $10. It might be actually, it might be different this time. If they cut the dividend, sell off some pieces, retool it, Telus could become a lot more valuable. So I think what you want to do is wait and see to look at what Victor Dodig is going to do with the company, because the asset base of Telus is great. It's just not performing well financially.
Is that what you think the company or this new CEO will need to do when he moves in, is sell off some of those assets?
Oh, he'll want to sell out. He'll want to retool the whole thing, because I hate to say it's a bit of a mess. And I'm not saying this about Victor. I don't know any other CEO. When you go in, you get stock options at a price. You want to get those things up. And so when you see someone who's of his caliber coming in to run the show, there'll be some things done, and it should be positive for the share price. I think. One doesn't know.
And as someone else who's holding Telus at the moment, you're not concerned about that dividend, right? Like as Harry mentioned, it's almost 10%, 9.9% at the moment.
Yeah. I mean, what happens usually when we see this has happened a lot in the market, is you might see a sell-off if they cut at first, then it could go back up. It's really just a clientele change. A lot of people who own it just for a high dividend will sell it off. And then other investors will say, hey, they're actually doing a smart thing by cutting it. There's more value in it, so you're going to get a different clientele coming into the company. We've seen that time and time again in the marketplace. But I think that, I don't know anything, but I think Telus is in for a big transformation in July. Just my thoughts.
Just your thoughts. Okay, all right, we'll wait and see if that comes to fruition. We're going to go back to the phone lines. Ozzy's calling in from Richmond Hill, Ontario with a question. Hi, Ozzy.
How are you?
I'm great. How are you? What's your question?
Good. I'd like to know what he thinks of the gold sector stocks, if they still have room to run.
Okay, thanks so much for that. Gold's been an interesting, had an interesting year so far.
Well, I mean, last time we owned a gold stock was, I think, 15 years ago. So I'm going to tell you, we don't buy gold stocks. If you really look at it, and I think if you look at gold, and I remember being on one of the programs last year, just before Barrick took off, Barrick had a 30-year return that was negative, where the gold price was up 8 or 9 times. So the stocks don't necessarily follow the gold price. In fact, a lot of stocks, what they do is once the gold price goes up, they make a lot more cash. The CEO pays himself a lot more. They find some country that they've never been to before and throw all the money in the ground there, and it never works out. When I say it never works out, in aggregate, you're even seeing Barrick try to split themselves into domestic and foreign, or all that, where there's a lot of risk there as well. And, so right now with gold, the gold price where it is and gold miners where they are, It's 10-foot pole territory. We wouldn't touch them with a 10-foot pole. But that's us.
Yeah, so you don't see it as a safe haven, as what so many people consider
why does
it to be. Yeah.
gold's a safe haven, but it goes up when things are better? It follows crypto. It doesn't pay interest. It does have uses. I mean, there's gold jewelry. There's some other industrial uses, but gold seems to be kind of it's almost like animal spirits right now with gold.
Right.
Our opinion.
Very
I'm sure the gold bugs will hate me today.
No, that's great. Okay, we're going to go to an email question. This one coming in from Helen, and it reads, what do you think of Amise? Would you buy it now? Okay, take a look at Amise. What are your thoughts?
Amise, would we buy it now? Yes. We do own it, and good of you, Helen, because not many people know what Amise is. It just became public not quite a year ago. It was the old Lafarge North America. It's one of the biggest aggregate cement makers and roofing companies in North America. I think the market cap's now about $30 billion. They're just undergoing right now a spin-off, so they're getting all their accounting in order. But Amise, we think it has a great future ahead of it. The CEO, Holcomb in Switzerland, spun it off. The CEO of Holcomb actually came and joined Amise, so took a step sideways or down and put his own money in, millions and millions of his own money into Amise. So we think that with Amise, you're getting a great business, a business that we owned once before when we owned Lafarge North America 20 years ago, and you're getting a very motivated management team, and it's a pretty good price right now. So.
Good time to buy.
Yeah, short answer is yes.
All right, we're going to take another quick break right now. When we return, though, we'll take a look at some of Tim's new top picks. That's coming up next. Stay with us. Join us tomorrow on Market Call. Dan Rahinton will be on the show. He is portfolio manager at IA Global Asset Management, and we'll be taking your questions on Canadian and global large caps. And if you missed Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. Tim Regan, of course, joining us in studio today. We're going to go through some of Tim's new top picks. So let's start with the first one. Allegion PLC. Did I say that right?
Allegion. It's a tough name because it was kind of made up. It was a spin-off of Ingersoll Rand about a dozen years ago or so. And I think I said that they're a boring
building products business.
Exactly.
Yes, an interesting description for this company.
They are the world's biggest lock and key maker, arguably. You're going to use their products every day, whether it's Slage Locks, that's one of their brands. They're also the biggest at making electronic key passes for the office. They're all over the globe. They're usually number one or number two in their markets, Europe, Asia, the Americas. And it trades very reasonably. I think it trades at now about 15, 16 times forward earnings. They're a growth company. They do a lot of tuck-under acquisitions, and they run under the radar. Essentially, it's an American company based in Ireland for tax purposes.
And you mentioned they're also going through a bit of a transition right now.
Yeah, a lot of they're going through more of a transition into the electronic space. That's become more and more of their business, which is great. But the other space too, half their revenues come from, we'll call it aftermarket parts. So, if you own locks or in buildings and security systems in buildings, the only way you can replace them is with the parts from these people. It's kind of built into the blueprints as well. And so, and they also acquire smaller security systems makers, lock and key makers, security makers, and they do a great job in rolling them up and bringing them into the fold. So it's both inexpensive and a growth engine.
Your next one is Colliers. What is it that you like about this company right now?
So Colliers, we had a question before on engineering companies.
Yes.
So So Colliers, everyone knows Colliers and their transactional real estate business and the brokerage, and they're all over the globe, based in Toronto, but international. They also have an asset management business with about $100 billion south of the border, and that's mainly in, we'll call it student housing, Air Force housing, different things. It's not in commercial real estate. But their third arm is engineering services, and they've been buying a lot of smaller engineering companies where it fits in, and it looks like they're going to double their revenue there in the next 5 years. And the other thing too, the management's great. Jay Hennick is still at the helm of Colliers, doing all the deals, and I think in the last little bit, Jay just bought a lot more of the stock as well. So it's good to see good management that's vested in it, and Colliers is a little more growthy. But, you know, if you look at the share price, it's come down a bit. So we think that there's a long way to run.
Even though, you know, it's a company that is in a competitive kind of landscape.
It's competitive, but that, you know, they'll buy smaller companies and roll them up. So there's a lot in that landscape. There's a lot of growth available.
Okay. Your last past pick is EQB. This one, I feel like we talk about this quite a bit as a kind of not up and coming, but a company and bank that's continuing to grow.
Yeah, you know, EQB build themselves a challenger bank, and they're the 7th largest in Canada. And really what they did is they were the first ones to really be digital. And in that way, they didn't have to have branches on every corner. They saved a lot of costs. You know, the mortgages they gave out were to people who should still qualify, but maybe didn't qualify at their local Big 6 bank for a mortgage. But what EQB did is they grew quite a bit, and just recently in December, they bought PC Financial. It's a fantastic merger. I mean, they bought it fairly at a decent price where it was reasonable to buy it, but it was cheap. If you look at all the synergies, it gives them a whole new platform, 600 ATMs. It's a whole new company if you want to look at that, but still with a good backdrop behind it, the digital banking backdrop. So we quite like EQB.
Because when you look at some of the other digital banks in Canada, like I think of Laurentian, which no longer a digital bank really, how does EQB continue that growth and continue to move forward, do you think?
Acquisitions like this.
Yeah.
And you'll see them probably, you know, roll up a few more things. They have to get this really, you know, under their belt. But when you look at it, there's, I think, 14 million people who have PC cards. You know, we all go to Shoppers or Loblaws, and they can now market to those people. And so they're a PC bank.
I noticed with all these top picks, there's no trend here in terms of sectors not that there's anything wrong with that, but I mean, just right now, given the landscape, given the market that we're seeing every day, some volatility, are there any sectors in particular that you feel are safer that you like to kind of stay in?
You know what? It's interesting you say that, because we're sector agnostic, and so we'll avoid a bunch. I mean, we're avoiding golds right now. The price is way up.
What else are you avoiding? Just because you said you're avoiding a bunch, now I'm curious.
Yeah, I think, you know, we're looking into some of the infotech companies because they've fallen off quite a bit, some of them. But at the same time, we haven't had as much of that. But really what we're looking for are companies that, regardless of the industry, whether it's waste management, banking, technology, can actually deliver returns for us. And if we don't like companies or don't like industries, we'd rather hold cash than try to force something into an industry.
Got it. And so then there's no sectors that you prefer at the moment, or feel like people who are maybe listening are...
I think
it's hard to predict the future.
The one area we've probably been overweighted more in is the financial services.
Right.
But financial services are not just Canadian banks, but insurance companies. Brookfield is a financial... the exchange, TMX Group, is a financial services company. They tend to do very well over the long term. They never get too expensive. So it's not a bad area to be in.
Okay, that's all the time we have, Tim. Appreciate you coming in. Thanks so much.
Thank you.
And thank you for watching Market Call. We will see you next time. Trading Day is next.